So in this case study, we are going to answer two commonly asked questions, which are, I'm not sure how much I should fund a policy with, and I'm not sure how long I should fund a policy for. These are great questions that we get on a regular basis. And to answer them, I'll often ask questions. For example, on the question of, I'm not sure how much I should fund a policy with. So this is a particular case where I'm working with an individual who is 39 years old, owns multiple businesses, one primary business though that drives the majority of his annual income, and he also invests in real estate. He knows with certainty that he can fund a policy with $50,000 per year. That's the first number he mentioned, $50K per year. I know I can hit that, and I'd like to set up a policy for maximum cash value. So back to the question, I'm not sure how much I should fund a policy with. Where this came from is he knew he could pay $50K per year in, but he also has a strong understanding of cash value life insurance. As he looks at whole life policies, he sees that the worst year of any policy is often the first year, meaning he makes a payment and he has less money than what he pays in. The best year about a policy is every year after the first year. Specifically, he makes a payment, premium and PUA dollars, and he sees more and more money come back relative to what he pays in. Gets better and better, and the compounding continues. So his specific question around, I'm not sure how much, is, hey, I can go $50K per year, but then if I have more money, would I just open up a new policy? And the answer is yes, you could do that. But the drawback in his mind, and in many people's mind, is, well, if I just start a new policy again, then I've got to go through those expenses. What would it look like if I equip a policy with additional space? So what if I pay in $50K per year, but I have a policy where I can fund it up to $100,000 per year? So I build in additional flexibility. Can I do that? The answer is yes. There's a potential drawback to that too, because if I go with a policy where I can fund up to $100,000 and never do it, well, now I've added additional expenses, a higher base premium, higher death benefit, and I'm not max funding it, so I will see the policy drag in terms of performance. So when one is not sure how much they should fund a policy with, what I like to do is show them the exact same thing that I'd want to see, which is, what does it look like if I max fund it at $50K per year, if I max fund it at $100K per year, and then have that same policy where I can pay up to $100K per year, but I only pay in $50, or a lesser amount than $100, so I can see what the actual cost is and if it makes sense or if it does not make sense. So his first question, I'm not sure how much. Well, we're going to answer that question by showing different options. Of course, we make recommendations throughout the process, but at the same time, it's your money going into the policy, so we want to see it up front, and then we can make an educated decision without having any buyer's remorse. The second question, how long should I fund? I'm not quite sure how long I should pay into a policy. You know, I like the idea of funding it for a short period of time, 5 or 10 years. That's a great way to maximize the internal rate of return. But then some people state, hey, I'd like to pay into this thing as long as I possibly can, up until the day I die. That way I can keep on building a big bucket of cash and also leave the largest death benefit to the next generation. Can I set it up in that manner? The answer is yes. You can do whatever you'd like, and different companies and products accommodate different strategies. We've got other content where we go through that in full detail. But in this particular case, I asked the question, well, how long would you like to fund? I don't know. 10 years? Do you like the idea of 10 years? I do, actually. You know, if I fund it between 5 and 10 years and stop altogether or pay maybe just a minimum premium, that is appealing to me. But again, we can't predict the future, so he might want to continue to fund it for a longer period of time. How about 20 years? After 20 years, his response was, probably not. After that point in time, I'm done. I'm going to want to start taking income from the policy. I'm not going to want to dedicate more resources to that. So what I often do in these cases is we stretched it a little bit, showed it for 25 years, but he can stop in 20 years, and he can even go beyond 25 years if he wants to. So, progressing on to this question here. So just to answer that question, actually, not sure how long I should fund, just like not sure how much, we're going to show different options. And often we'll show it with the exact same policy and company. This way, you as a consumer can pick the option that you feel is best for you. And then this question, we kind of touched on it before with not sure how much. What if I go too high? So specifically, what if I pick the option where I can fund up to $100,000 per year, but I just don't hit that 100K per year? How much will that cost me in terms of the cash value not performing at the greatest level possible? This is the kind of stuff that is great to have awareness on. And it's always good to know about it before you put your money into a product, because it's your money and we don't want to see any financial loss. So, company choice. As we looked at different options, he's interested in the major mutual companies, your 4 major mutuals, because they have a track record of delivering strong cash values to consumers. He already has a policies actually with New York Life, which he's had for a while, so they'll be performing now. Those keep them exactly as they are. We're going to consider Mass Mutual and Guardian primarily because of the flexibility that they offer. So, just to provide a summary, Mass Mutual works very, very well if a policyholder is comfortable and disciplined with one time per year payment adjustments. How it works specifically is if it falls on your policy anniversary date and you have the right riders attached, specifically their LISR rider, that allows you to bounce payments up and down one time per year, every year, without any medical underwriting at all. Now you can add some additional flexibility through their planned AILR rider, which does have some items that are associated with it that are not that flexible. A lot of people aren't aware of the planned AILR rider, that you can actually add funds at leisure without underwriting up to 3 times per year. But again, it has some drawbacks as well, and we cover that in other content. And then Guardian has a lot of flexibility, also being one of the major mutual carriers. So one, how do I just select the cream of the crop in terms of companies and products that have actually delivered strong cash values, not just projected them on paper, but actually delivered? All your 4 major mutuals have. Guardian is very flexible, whereas a policyholder, I can commit to a minimal premium, and then at my discretion, I can just throw money into PUAs. That can be through my online portal, it can be through my mobile app, whatever I prefer. I can send in a check, doesn't really matter. Very, very flexible in that respect. Their sweet spot, however, is funding a policy for 10 years or less. You can go longer than that, but are all about Guardian video and other content touches on the flexibility there. But just some notes on the flexibility. If he says, I want to be able to go up to 100, but I only want to commit to 10 and have complete flexibility to throw the rest of the 100K in whenever I want, Guardian works very, very well. If he says, my cash flow is pretty predictable, I don't need to have the option to throw money in at leisure, Mass Mutual can work very, very well. Mass is also a great option if I want to have the ability to carry a 1090 split and pay into the policy for 20, 30, even 40 or 50 years without having to worry about a mech or anything like that, just how you can design those policies. We're not going to look at loans in this particular video. In other case studies, we will cover that quite a bit. He is interested in using the policy, specifically the loan feature, whether it's direct loans with the life insurance company and from his cash value, or cash value collateral loans, which involve taking the policy to a bank, assigning the cash value as collateral to them, and then getting a line of credit, typically at a lower interest rate. He specifically wants to use it for real estate and supplies for his business, equipment specifically. So the policy design. Here's exactly what we did in this case. So we talk about this frequently. If he wants to go up to $50,000, if that's the maximum, as we're going to show examples on that, $50K per year, how we would set that up would be a policy with a $50,000 Mech limit. The Mech limit is the maximum amount of money you can pay into the policy per year by the IRS standards and still have the IRS view the life insurance policy as life insurance, and therefore, when it comes to the cash value benefit, reap the core benefits, which are what? Safe. This occurs whether the policy is a mech or not. But the next two, liquid, being able to access it any time. And then 3, tax-free. If a policy becomes a mech, you give up a lot of the second and third bullet point. Specifically, on the liquidity, you can still access it anytime you want, but if you do access it, you have to deal with tax consequences. You lose the tax-free piece. How a modified endowment contract works is if a policy becomes a mech, You have to pay ordinary income tax on the gains, and if you're under the age of 59 and a half, you have to deal with a 10% penalty tax as well. If you're disabled, there is a way to work around, or where you do not have to pay the 10% penalty tax, but you still have to pay income tax on the gains. So we don't want a MEC, it ruins everything. So the MEC limit is exactly what it sounds like. Now you can set that MEC limit wherever you want. It has a direct relationship to an individual's age and total death benefit on a policy. So when someone states, I'd like the minimum death benefit because I want the minimum cost, the death benefit's not a concern to me at this particular time, what we'll do is solve for the minimum death benefit to be able to get, in this case, $50K per year into the policy. Then based on the insurance company limitations, a lot of the major mutuals will allow you to set that premium as low as 10%. That's where we come up with the terminology 1090 split. It is as low as we can go with the major mutual companies. Guardian lets you go a little bit lower, just over 9%. Mass is a clean 10%. That's as low as they'll allow. If you try and go any lower, they'll kick the policy back at you and say this is not approved for sale. Premium dollars typically do not show up in cash value in the first year, and sometimes the first and second year. This depends on the product. The reason why is because with the premium dollars, the company is going to overcharge me for the death benefit up front. Now we'll also add a term rider. In this case, that'd be about $500, which gives me no cash value on any year because it's a pure cost, but it does really give me a nice sized death benefit, which allows me to raise that MEC limit at a very, very low cost. One thing I forgot to mention here, premium dollars do build cash value as the years pass. So it's not just a pure cost forever, which is nice to know. The traditional product, I'll see it come back beginning year 3. Some products, like the Guardian option will show, comes back year 2. And then some do credit about 80% high early cash value products in the first year, which we're actually going to look at in this example. PUA dollars then, in this example, this would be what? About 44.5. So we've got a total of 50 going in, 5,000 toward the base, 500 toward term, plowing everything else into PUAs. That shows up in cash value, minus any PUA fees. There is a charge typically, but it's minimal. Does buy me some death benefit, but stuffing that cash value gives a business owner money he can access right away, begins to earn to the guaranteed rate, dividends, everything compounds and accelerates. A question we get very, very frequently from individuals is, hey, I have a life insurance policy. If I would have known that I could have had more cash value up front, that would have helped me with opportunities that I have or had just recently. But I didn't know I could optimize the cash value further. So they're very, very interested in the opportunity cost factor of using that policy for opportunities, real estate, business, whatever it might be. Now, if he decides to go with the 100K MEC limit, here's what we would do. Very, very similar pattern here, or similar strategy. The difference is we'd have a $10,000 base premium, which again, does not show up in cash value right off the bat. The term rider may be double. We'll have to double the death benefit in order to double the MEC limit in this particular case. And then everything else into PUAs, which in this case would be 89.5. Fun stuff, right? How this works. So rather than me draw out the numbers, let's actually look at the numbers. What I want to do first is break down exactly where his money is going. So if you work with us, what we will always show you are the detailed illustrations and also a simplified comparison sheet. We try to provide full transparency and make things easy to understand. You can always let us know, hey, I'd like the detailed explanation or I'd like the simple explanation. And we'll aim to accommodate either or both if you'd like. So with this, where's the money going? I've got a total of $50,000 per year going in for 50 years in this example. This is a policy with a $50,000 MEC limit. So where his money is going, here's the underlying premium, $5,000. Then we've got other riders attached. We've got term insurance. Does not cost $3,000. About $500 is allocated toward the term premium. The other 2,500 is directed toward PUAs. And then this 42,000 is just a pure PUA rider with this company. So, 50K total going in, breakdown of where the money's going. This death benefit gives him, in this particular case, a $50,000 Mech limit. All right, so we've got that. Where's your money column? Net cash value. That is an ugly circle. I got to redo that. There we go. Not much better, but a little better. So this is actually a high early cash value product because he's a business owner and real estate investor. We like to show an option with more cash value up front. We're going to show long-term options as well. But here, 50 goes in, 46 right off the bat. What high early cash value product means is that 5,000, about 80% of that shows up in the cash value right off the bat. You can see that in this column. This represents base premium dollars that credit the cash value. It also assumes just the guaranteed rate that's being credited to a product. My point is about $4,000 is 80% to $5,000. That's how much of the base premium showed up in the cash value in year one. As we continue to pay in, break-even point between years 4 and 5 in this particular case. So this is where he has his money back, where he's cash on cash or break-even, whatever we want to refer to it as. This, many people are interested in. The long-term performance is great, but consumers are very interested in the upfront cash value. And what I've heard expressed from so many business owners is it's an opportunity cost. Like, the less I have up front, the less interested I am in the product. I want this money for opportunities for my business because my business is how I've grown my net worth, not the life insurance policy. This is a great area to store cash, use it as that tax-free savings method, and also use for opportunities like business. But the cash has to be there. But here's what I want to illustrate here. So remember the questions, how much should I fund? This is an option where you can fund up to 50. Then what was the second question? How long should I fund? So here's what's interesting about this. This is an option where he pays into it for 10 years. And look at your cash value, 568,846. Look at your death benefit, 221,252. Keep those numbers in mind. Also look at the first year. And this is on a video, so you can rewind too. But I'm going to look at the exact same policy, but funding it for 25 years in this case. Before we scroll down, tell me if you notice any difference whatsoever. The first year, the break-even point, the 10th year, no. Now, after the 10th year, you will notice a difference because he's going to continue to fund the policy with $50,000 per year. And here's the beautiful feature. He does not need to decide upfront how long he wants to pay into it. This can be a decision after the fact, meaning I can take out a policy, plan to fund it for 10 years, and then keep on going if I want to. You can do that with Mass Mutual with the products and riders they have available. Some companies you can't quite do that. You need to know with more certainty what you'd like to do up front. But this is the kind of stuff we like to go over up front. So, there we go. 10 years and 25 years. Let's take a look at this guy. A lot of options, right? What I'll start with here, we're going to blow this up. These are the two examples we just looked at, but side by side. Makes it a bit easier. And going back and forth. Age 39, at the end of the first year, he's now 40. There's the breakdown with where the money's going. You'll notice these values are identical to what we just looked at on the illustration. You've got 50K per year going in. There's your break even. Annual internal rate of return, not your average. This is your annual growth rate. So I love this column, or including this in Excel spreadsheets, or putting it on illustrations for that matter. The reason why is Mass Mutual, great company, has a dividend interest rate of 6%. However, I am not earning 6%. Showing the IRR provides so much transparency, in my opinion, where here, the first and second year, if I've got a dividend of 6, even if it's 600%, I don't care what it is. If my actual growth rate is less than what I'm paying in, it's a negative IRR. So for example, I pay in 50K, I've got 46,000, just about a negative 8% internal rate of return. Next year, I pay in 50,000, it grows from 46 to 94,000 and change, meaning I did not get the 50K back that I paid in. That is why the second year I have a negative internal rate of return. And then each year thereafter gets better and better as the years pass. But again, here's the fun part, Same policy, side by side. The option to the right just represents what the policy looks like if he decides to keep on funding it. Now here's something I want to point out as well. What do you notice with respect to the internal rate of return on these guys? If we just look at year 20, where this one, he stopped funding it, 6-7%. This one, he continues to pay into it, 4.22%. There's a difference there. If you're going to continue to pay into a policy, you will typically see a lower internal rate of return. This is due to premium loads. We still have a term rider attached. PUA rider fees, especially since the 7702 chains have a big impact. That is why I see a lesser internal rate of return. Now, you could also argue that, hey, yes, I have a lower IRR, but I'm pumping more money into this policy that continues to compound for me, which is perfectly fine. But some people look at that and say, you know what? I'd rather maximize it. It's always up to the consumer at the end of the day, as long as they see the options. That's the thing. So let's continue on here. What we've got to the right is a policy twice the size. Literally just doubled everything. 100,000 per year, breaking even at the same point in time. And then for 25 years. So we've got an option here, side by side, where he pays in 50K per year, and then 100K per year. Make that a touch bigger. There we go. Ooh, might have to tweak that a bit. Voila. Okay. Now, how much should I fund? Between $50,000 and $100,000. These options represent what a policy looks like if he max funds it each year. Right? So he max funds it at 50K per year, then he max funds it at 100K per year. We have not addressed his question, which is, what if I go with this option, but I don't get up to $100,000 per year? I only get up to $50,000 per year. So let's have some fun and take a look at that. So here we go. Same policies we've got up here. Here we go, $50,000 Mech Limit. So the Mech Limit, when we see these terms, represents the maximum dollar amount we can pay into the policy per year. We also see that based on the base premiums, as we can go with a 10% minimum with Mass Mutual in these cases. So $50,000 Mech Limit. This example will look very familiar because we've spent a lot of time on it, breaking even between years 4 and 5. Then we've got the 100K Mech Limit. But what's your payment? I'm going to circle this in gold. Annual outlay represents the actual dollar amount that he'd be paying in. So the question was, how much, and what if I bite off more than I can chew? I can go up to 100, but what's it look like if I only pay in 50 and then stop in 10 years? Very, very nice to see this stuff up front. Well, what happens? Doesn't break even between 4 and 5. Breaks even at a clean year 6. Based on the present dividend rate too. I've paid in $300,000 and I have $300,000. Continues to grow. Year 10, I've got a total of 552, whereas over here, I've got 568. So there's a difference. It's not huge. This is where an individual will look at it and say, okay, I see a difference here of what, about $16,000 when I really look at it. Not quite, but we're just going to round, $16,000. Over 10 years. Is that $16,000 cost worth having the ability to throw up to $100,000 per year and not needing to go through startup costs again? If so, it makes sense to go with this option. If someone looks at that and says, no, I'm just not comfortable with that. I don't want to lose 16 grand or any dollar amount. That's where I would max fund it. Maybe we look at some options in between as well. Here's the same policy now. So these two are actually the same. Why the death benefit's a little bit higher in this is we've plowed more money into PUAs which pushed the death benefit up. But the same policy, same base premium, same term rider, everything's identical. Breaking even between years 4 and 5. But getting 100K per year in, which obviously helps the compounding and the growth over time. And there's times we'll look at scenarios where, hey, what's it look like if I only get 100K in for 2 years and then 50K per year thereafter? Seeing that kind of stuff up front. People love it. And so do I. All right. So some good examples there with Mass. Let's look at Guardian quickly here. So we mentioned earlier that a sweet spot to Guardian products is if I want to pay into it for 10 years or less. 5 years, just max funding it and then stopping altogether, or maybe paying a lesser amount. That's a great way to maximize the internal rate of return, specific to a Guardian policy. If I want to fund a Guardian policy for something like 25 years, like the other example we looked at, I'm not going to be able to have a 1090 split. I'm going to have typically a 25-75. That'll be the lowest I can drive it, just to provide awareness there. You can get a 1090 split and fund between 15 and 20 years, but it's often counterproductive because just how Guardian's product is equipped, the need for a large term rider, doesn't always make sense. If someone says, hey, I like the idea of Guardian and funding at the max level for 10 years with a 10x the base premium, a 1090 split, and then stopping or cooling off and paying just a reduced premium, the base premium or that, plus another 10,000 in PUAs, whatever the dollar amount is, that's where you can make the product hum. But those little bullet points, those details are so great to provide awareness around. That way I can make the right decision up front. So here we go, 100K total going in. Where's the money going? Premium, $10,000. Can actually go a little bit lower there if we wanted to. That gets me a whole life death benefit of about $500,000 or $20,000, which would give him a Mech limit of right around 20 to 25K. His Mech limit on this policy is 100K. What has a direct relationship to the Mech limit? Total death benefit, $2.1 million. That's not 2.1 million, but that plus this is 2.1 million. So what this guy is a target additional benefit, which is a term insurance rider, which is a cheap or cost-effective way to raise the death benefit. Here's the cost. It is a 1-year term insurance rider. Our OYT full transparency video provides details on exactly how that term rider works if you're interested in that. But here we go. Check this out. Here's an option where he max funds it for 5 years. So we're taking advantage of the product limitations. Cash value, breaking even, clean year 5, based on the present dividend interest rate. This is based on a regular preferred healthy individual, 39 years old. But if he says, I'd like to continue to pay into it, not quite the 100K, he's comfortable with that, but a reduced amount. He can do much more than this. He can actually do 40K per year, no problem. But here, we ran $25,000 per year through year 20 to show some variety. Fun stuff, right? Look at this. There's the cash value. You've got the death benefit, almost at a clean $3 million by year 20 as well. And then it continues to compound. He can take income from it at that point in time, whatever he wants to do. So let's wrap up with a comparison sheet here. So what we've got, same thing we just looked at with respect to the MassMutual examples, where what's it look like if I max fund the policy? So here, 50K Mech limit, different company this time though. Funding it, just like what we saw, but cut in half, 250 total, 50K for 5 years. There's your break even in year 5. Then, here's a policy where I've got a $100,000 Mech limit, but I only pay in $50,000 per year. So here we go. Break even falls between years 6 and 7, just about year 6 really, but technically it's between 6 and 7. Dividends go down, it will be year 7 in this example. So what's interesting about this one is look at your internal rate of return. So annualized, where you max funded it, especially the first year, negative 17% versus negative 26, almost 27%. And year over year, let's look at year 10. almost 4.74% versus here, you're 3.48% year over year. Now it evens out beginning year 11. The reason why is because we executed a reduced paid up at this point in time, which kills the premium. What you'll notice with Guardian policies is if we hit the kill switch, which I refer to as the reduced paid up option, that levels the playing field, and from an annualized IRR standpoint, you'll see it consistent on each policy regardless of what your base premium was. But if you want to juice it, meaning max fund it, having a 10/90 split for a certain number of years will do that almost every single time. So 100K Mech Limit, far right, 100K Mech Limit, but funding it at the 100K per year and stopping after 5 years. Then we show what it looks like. If he wants to continue on, so here's the 100 for 5 years, but then consistently paying thereafter. So this is the kind of stuff we show to a lot of people that like to see these kinds of details. Some just want to see a more simplistic version, but ultimately it's up to you. Depending on the company flexibility, different products, different options, people that want that transparency before starting a policy. That's really the purpose of this case study and all of the information we provide. So I do hope that you enjoyed this. If you did, please hit the like button, subscribe for more. Thank you so much for watching through the end. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.